Another method of costing is life cycle costing. So, life cycle costing occurs when we consider all the potential resources consumed by the product over its entire life. So, these are costs that stretch from the development and research and development costs through its warranty and disposal costs. So, this spreads those costs along the entire life cycle of the project. Life cycle costing is more commonly used in industries where research and development costs are extremely costly and it takes a very long time to get a product to market because the research and development period is so long. Examples of this would be pharmaceuticals. So pharmaceutical companies frequently use life cycle costing because they have very heavy research and development costs, and it takes a very long time to get a pharmaceutical from development to market. So when we're talking about target costing, we know that the entire value chain needs to be involved because what we're trying to do is satisfy customer needs to keep our costs underneath what that customer is willing to pay and still allow for us to have a profit as an organization. We're trying to reduce development time and reduce our processes. In order to implement target costing within our industry, we have to really understand what is going on in that product development and creation so that we can analyze it in ways to reduce any non-value added activities. The next thing we talk about in chapter 19 is a concept called just-in-time inventory. So just-in-time inventory is a procedure used to reduce cost. It became popular very first in tech-oriented companies where having pre-made inventory what actually cost them more money. So because technology changes so fast and so frequently, we no longer create a bunch of inventory, keep it stored in a warehouse until it's available for sale. Under just-in-time manufacturing systems, we don't finish manufacturing items until it is needed to fill a customer order. So we develop these manufacturing processes that can create things very quickly or so that we can still get to the customer in time. So just-in-time manufacturing is used very much now in manufacturing so that we no longer pile up inventory. This it's called a pull system because the customer drives the demand. When a customer order comes in, then we manufacture. Traditional manufacturing was a push system where we would produce as many goods as possible, keep them in a warehouse, and then they were just available when our customers needed them. So we have very small or non-existent inventories of materials, work in process, and finished goods. We have a system set up so that our materials are scheduled to arrive only as we need them. We have very good relationships with our suppliers, so we know that we can get items quickly and we don't have any downtime. We also don't have finished goods in excess of our existing customer orders. So for example, John Deere would use a just-in-time inventory process. So John Deere doesn't make a whole bunch of tractors that are just sitting in someone's parking lot waiting to be sold. Instead, they wait until they receive an order, they make just as many items to meet the request of that order, and then stop production. They don't keep producing. So the goal of a just-in-time inventory system is to eliminate costs associated with storing inventory because storing inventory is not a value-added activity. but it is a costly activity. Maintaining warehouses and keeping inventory safe from theft and spoilage is a costly process. So we have this example of the value chain and how we look at the value chain when we're looking at this demand pull. So customers first order inventory. They want on-time delivery. They want it to be quick. They don't want to wait a long time for it. Then we have our factory production. We don't want to have finished goods inventory sitting around. We also don't want downtime, wait time, or defects. So we're continuously increasing our quality, our employee training, the teamwork that we do, and our process design efficiency. So how is our production even created? And are there ways that we can reduce times that it takes to produce materials? We also have good supplier relationships. So we have long-term contracts with them. We might even purchase our suppliers. This is a popular thing in just-in-time inventory, so that we guarantee that we have on-time deliveries and supplies ready when we need them. So we need a limited number of suppliers who will make on-time delivery of our quality materials. We need quality that is designed in, not manufactured in. Okay. We don't want to spend a lot of time on quality inspection, so we want to make sure that every product that we're creating when we create it is coming out. We need a well-trained and flexible workforce, and then we also need an efficient plant layout. So there are particular factory layouts and designs that work just for just-in-time inventory systems. When we're measuring how efficient a just-in-time system is, we use a thing called cycle time. So cycle time is the length of time required for a product to pass completely through the manufacturing process. This includes the production time, any storage and waiting time, its movement time, and its inspection time. Only during that processing time is value added to the product. Storage time, waiting time, movement time, and inspection time need to be reduced as much as possible because they are not considered value-added activities. Now, we would think that inspection time would be a value-added activity because as a customer, we want to make sure that our products are the highest quality possible and that they're not coming to us with any defects. But in actuality, that quality should be happening during the construction anyway. So if we're finding a lot of defects during inspections, we have other problems that need to be addressed, and none of that is considered value added. So our cycle time is our value added time divided by our cycle time gives us the manufacturing efficiency ratio. The amount of cycle time is just all of the time spent on production added up. So our manufacturing efficiency ratio is also called a throughput ratio. We're looking at the time spent in value added activities as a percentage of total cycle time. Obviously, our optimal efficiency is 100%, which means that zero time is being spent on non-value added activities. In practice, however, it's very difficult to maintain a perfect system. So there's really no such time as a perfect system because we can't eliminate every single possible thing that could happen. In a perfect system, we would never have employees out for any reason. We would never have downtime. We would never have machine breakages. So we can't always control for this perfect situation, which would give us that optimal 100% efficiency ratio. The next thing that we cover in chapter 19 is measuring quality. So especially in accounting systems and just-in-time companies, we measure quality as well as costs and cycle times. Common indicators of quality include what are our defect rates, How often is merchandise being returned as defective? How many warranty complaints are we receiving? Do we have customer complaints? And what are our customer satisfaction results from surveys? We have 4 different costs of quality. The first is prevention costs. Prevention costs refer to the cost of resources that prevent defects from occurring. So we prevent defects from occurring in the first place. That's a prevention cost. Examples of prevention costs are employee training, quality processing audits when we go through and look at what are our processes and how can they be improved, embedded quality control costs in target costing of our new products. So we're making sure that we're already doing quality control throughout the entire value chain and looking at our suppliers to make sure that they're giving us the highest quality materials available. The second type of costs are appraisal costs. These costs are incurred to determine whether our products conform to quality standards. So this inspection is an appraisal cost. We inspect materials as they come in, we inspect our products that are currently in production, and we inspect finished goods inventory before they go out the door. We monitor our production processes, and we make sure that our equipment is always maintained so that we ensure quality and we reduce the number of downtimes from machine breakages. Internal failure costs. So internal failure costs are things that relate to us having low quality output. Examples include when we need to rework products that weren't created correctly the first time. Downtime. So any downtime related to machines are broken or we have to repair different things or we weren't maintaining our upkeep. Disposal of scrap from various reasons. So our employees are still learning and they end up creating a lot more scrap materials than good finished products. Processing any change orders because we've made last minute changes to design. External failure costs are the highest cost and the most difficult to measure. These are the costs that occur after our customer has already received our item. So this is what happens when our item breaks after it gets into the customer hands for any various reasons. So things that have external failure costs are one, we lose sales because we get bad reviews and our customers will no longer buy our products because they don't trust us anymore. Any cost that we have in processing product returns and dealing with defective products coming back to us. Warranty costs. And then we also have product liability costs. So what happens if we sent out a defective item and that defective item resulted in a death of someone? We're going to be sued. And so we have those liability costs that come from being sued. You might remember any automobile recalls. So automobile recalls are fairly standard things. But what happens when they find out that the defect that caused the recall was something they actually knew and they let those cars go out anyway? Well, then that results in a lot of expense and potential lawsuits for those manufacturers. This is an example of how we look at those costs of quality. So first we have some prevention costs listed. We have training costs, machine maintenance to make sure that they don't break down, quality planning. Then we have appraisal costs, which are all of our inspections and testing, our internal failure costs from rework, downtime, and scrap, and our external failure costs from warranties, lost sales, and repairs. And then we add all of those costs up and we determine what percentage of sales are those costs of quality. So then we're going to talk about ethics, fraud, and corporate governance. So the Sarbanes-Oxley Act requires public companies and their auditors to issue separate reports on the effectiveness of their internal control structures. So we know that these internal control structures include all of these measures that are guarding against errors, waste, and fraud, which are all considered non-value added activities. The objective is that we increase the quality and reliability of accounting information. So we want to trust accounting information that companies are putting out. That is why all current regulations exist, especially the Sarbanes-Oxley Act, which came about after the Enron fraud and created measures to increase the public belief that accounting information was good and not fraudulent. So internal control measures are actually very expensive for companies to maintain. So businesses sometimes question whether these required reports and the required audits are actually value added. In fact, smaller companies complain that the cost of internal control reporting places a huge burden on them given their size. So there's this conflict between how much it costs for companies to prove that they're doing all that they can to benefit fraud and to prove that the public should have confidence in their accounting information, and the idea that the public actually does trust accounting information. And what kind of cost should we put on that? And should that cost be a burden to the company in time and management? That is the end of chapter 19.